Hello, everybody. It's a pleasure to be with you today. My name is Sajid, and I'm currently working with Habib Bank AG Zurich as a Deputy CRO. First of all, thanks to Risk Awareness Week conference organizers for inviting me to conduct this workshop, which is acting rationally in an irrational market. I'm very passionate about wealth management and investment risk, so I follow them very closely. This is a brief introduction about myself. You can read about it. This is a very important disclaimer. So today we are going to look at quite a few interesting topics in our today's workshop. All these topics and concepts are fairly big topics and easily could take a separate full workshop on them individually. So bear with me, and we are going to go fairly rapidly through these and not in a huge amount of depth, given the limited time available to us. But I hope, nevertheless, you will find some of these ideas a bit challenging, stimulating, and certainly interesting. So today we'll start with some basics, and we will briefly look into traditional investments and traditional investment strategies. We will then move to details of rational investing, and we'll discuss the efficient market hypothesis. After that, we will discuss about some pitfalls of traditional and rational investing and efficient market hypothesis. I will present you a case study to understand it in details. The tools presented in a case study will also help you to evaluate your investment decisions. Then we will quickly touch upon the non-rational or behavioral investing and how it is contrary to rational investing. Last but not the least, I am going to give you a very important and secret investment strategy, which I believe could really help you to create huge amount of wealth if you adopt the idea in your thought process while working towards your wealth creation goals. So it's going to be very interesting workshop, but you have to stay with me till the last. I promise you will not regret, and the time you are investing here will not be wasted. So I will quickly touch upon the basic and traditional investment types. In financial world, we call them asset classes. So an asset class refers to a group of assets with similar investment characteristics. Within an asset class, the financial security exhibits similar risk and return patterns. You can see that I have provided some example of instruments or securities in these asset classes and also their popular constituents. For example, cash usually meant for readily available liquidity, which provides the purchasing power to the investor. In the bottom part of the slide, you can see some traditional investment strategies. In short, we can say that these investment strategies help investors choose where and how to invest as per their risk appetite. For example, their expected return, available funds, long-term or short-term holdings, retirement planning, choice of industry, sector, etc. So risk appetite of an investor defines their investment plans, the objectives and goals they want to achieve. I will not go into the details of each and every strategy mentioned here because this requires separate session for each of them, and this is not the purpose of our workshop. However, we only need some basic understanding of these so we can understand the what the pitfalls of these investment strategies are. So you can see there are 7 different types of investment strategies. You can understand some of them as their name suggests. For example, passive and active strategies are basically about the frequency of buying and selling and holding period. Growth and value investing is about investing in companies based on their growth prospect and rise in their intrinsic value. Income investing strategies focuses on generating cash income from stocks. In a dividend growth investing strategy, the investor look out for companies that consistently paid a dividend every year. Contrarian investing strategy allows investors to buy stocks of companies at the time of down market. Indexing investment strategy allows investor to invest a small portion of stocks in the market index. These can be S&P 500, mutual fund, exchange traded funds. So what do we mean by rational investing and efficient market hypothesis? Well, according to this theory, we are making certain assumptions here. And first is that all investors are acting rationally all the time, and they are always trying to maximizing the return while minimizing the risk. There are other certain assumptions in efficient market hypothesis that is that all new information is immediately available to everyone simultaneously and therefore immediately discounted in the price. So for instance, if you have a model where an asset is worth of $100 and some news comes out which is made available to everybody through public news service, and you put new information in your model and you found that assets should not be worth a fair value of more than 110, then logically, if everyone using similar fair value models, then price should move very rapidly from 100 to 110 and then stabilize. Now, this therefore assumes all securities always trade at their fair value, and also assumes that most people are using similar price models. I think it's fair to say that many people in financial service industry have been to similar business schools. They went to similar kind of universities who run similar courses using similar models, which some of them we are going to look at today. And therefore, it tends to be that fair value models are not too dissimilar from each other. On that basis, therefore, if everyone has access to exactly the same information and exactly the same time, and they are using pretty much same kind of models, then it should be impossible for anyone to create any return which is above that of risk-adjusted average. Maybe you can do it once or twice, but on a consistent basis, it should be impossible. Now, there are three forms of efficiency, and I'm not going to go in depth of three forms, the weak, semi-strong, and strong form, but all their real difference is how much information is made available to all investors at same time. So for instance, all information is public, which also includes some private information available to certain people. So for those who want to look into more depth, you might need to follow a key proponent of this efficient market hypothesis, and that was Eugene Fama, who notably won the Nobel Prize for this effort, for his effort in 2013. So now, why there is investment analysis and valuation models? Well, one way to describe it, that you cannot invest without analyzing stocks and underlying companies, that would be akin to running on a highway blindfolded. Now, there are many kinds of share markets analysis, which can be broadly categorized into two categories, fundamental and technical analysis. A fundamental analyst would mostly definitely look at the balance sheet, the profit and loss, financial ratios, or the data that could be used to predict the future of company. In other words, fundamental share market analysis is about using real data to evaluate stocks value. The method uses revenues, earning, future growth, return on equity, profit margins, and other data to determine companies' underlying value and potential for future growth. The basic belief is that As the company grows, so will the value of share increase. This in turn will benefit the investor in long run. We can understand price to earning ratio, PE, with an example. Suppose a company A earns $50 per share. Its current share price is, let's say, $100. Its PE ratio is 2. Suppose the average PE ratio for the industry is 5, then company is undervalued. If there is another company in the same industry with the PE ratio of 10, then stocks will be considered to be overvalued. However, an analyst expect the company to earn $100 per share in the next financial year. Then the forward PE would be 1. This shows that price is even more undervalued when you consider the company's growth. Now, we have understood the value investing, which is by following the fundamental analysis, but there is another investment philosophy called contrarian philosophy, which suggests trading against the market sentiment. This means you buy stocks when they are out of favor in the market and avoiding stocks that everyone is buying. Investors then sell these stocks when they gain back the favor. So simple example of contrarian philosophy, we can say, would be buying umbrella in winters at cheap rate and selling them during rainy days. Once again, I'm just putting this information as a reference point for our main focus point. So I would not go into much details here since these topics require separate sessions to cover each and every aspect. So I will just mention the key highlights. Valuation actually is the process of determining the theoretical correct value of a company or investment or asset, as opposed to its cost or current market value. So common reason for performing valuation are basically merger and acquisition, strategic planning, capital financing, investment in securities. So the 3 most common valuation methods you can see are discounted cash flow analysis, comparable company analysis, and precedent transactions. So in addition to efficient market hypothesis, we could also look at 2 most famous and important concepts, which are modern portfolio theory and capital asset pricing model. I have mentioned the key proponent of these concepts who are Nobel Prize winner for their field of work. If we talk about MTP, modern portfolio theory, Harry Markowitz's work is all about constructing portfolios, specifically to maximizing the return and while minimizing the risk. Key focus is not necessarily on the individual risk and reward of each security in its return, but for how each security would impact total portfolio in terms of its risk and returns. But modern portfolio theory requires certain assumptions too. First of all, you need to know what your risk tolerance is as an investor. You have to quantify that it is that, and you also assume that you will always behave rationally. We look a little bit more about that later, about challenges to the assumption of totally rational behavior. Now, this also assumes that forecasts of returns on the individual assets are reliable. Well, we just look at several ways in which we can forecast returns on different assets using various fair value functions, and I would suggest perhaps the modern portfolio theory, it could be challenged perhaps in terms of how reliable some of the forecast of the returns are, and therefore the variance and correlation between assets must also be suspect. And this again is a key aspect of modern portfolio theory. And now finally, we can look at another concept in terms of rational investing. The CAPM is the relationship between what an asset is expected to make and what is the risk of holding the asset, and that return is defined as, we would call it, a risk-free rate. This is the return you would get from an asset which shouldn't change its value, and actually it should hold its value. Now, typically this could be 10-year US Treasury bond because it's issued by US government. Therefore, it seems to be the lowest risk asset. Or perhaps you could look at short-term, or maybe look at 3 months US Treasury government bill. Whatever it is, you then going to take rate of return from that risk-free assets and add to the premium of risk for the asset you are trying to measure. And then you get to multiply that risk premium by beta. The beta refers to the volatility of return on that asset relative to return of all overall markets. So we have tried to understand the key component concept of rational investing, efficient market hypothesis, and some valuation and portfolio models. Now let's see what is not working and what is broken. In other words, what are the pitfalls of rational investing and efficient market hypothesis? I would go through these fairly rapidly, but you will get the key concepts. So here I'm going to use Tesla as US equity as a case study to test the efficient market hypothesis and rational investing concept. Here you can see that we are looking at the earning estimate graph of Tesla shares. We are looking at it for the period of almost 7 years. And we can see in red where the earning estimates have changes over different periods. And in white, we have overlaid that with the price of stocks of Tesla. Now, the red line, the earning, as you might expect, do show some tendency towards a random walk and relatively a non-trending movement. And that is to be expected. You think, therefore, if everyone is trading in line with efficient market hypothesis, that the price should move relatively closely in line with the earning estimate. But what we could see here, it doesn't. In fact, if we look closely, you can see that generally speaking, the price, the white line, tends to move up and down a bit before the earning estimate. And this basically suggests that price has more information in it than simply the efficient market hypothesis in terms of earning estimates. Indeed, you can see that a movement of price, the white line, follow much more of a trending nature. Generally speaking, I mean, in this market, it's been up over the last few years, but you can see also on numerous occasions, it has countered trend down for short periods. So price does not seem to move in line necessarily with one example of efficient market hypothesis, which is earnings. So now we look at one more example of efficient market hypothesis, which is dividend discount model. What is striking about this example is that the valuation which is thrown up, I mean, this model shows the theoretical value of $26, and yet the price is closely to $283. That is substantial difference. Again, that suggests the price is not moving in line necessarily with some of the fundamental analysis. Then we look at the analyst recommendations. I mean, surely after all, analysts should know what's going on. So in this case, what we are looking at here is looking at white and yellow lines. So again, current market price $283, and yet analysts are currently forecasting a 12-month target of $301. Well, that would suggest that analysts know something which the rest of us don't. Why are analysts forecasting $18 rise over the next 12 months? Because surely if the fair value models everyone using are the same, everyone should be able to see that fair valuation should be $301, not the $283. So are the analysts trying to suggest that they are going to beat the efficient market hypothesis? They are going to beat the average? That seems a little bit odd to me, given that they are only using the fair value models. Again, however, we can also see very closely that yellow line in the market price changes up and down and changes direction very slightly before the analysts change their target price. That would suggest that perhaps what the analysts are doing to some extent is adjusting their recommendation in terms of the price, and the price we have already seen seems in some of the other example isn't necessarily is the same thing as the fair value. Let's look at the example of CAPM. Here we can see at the bottom of the chart the risk free rate in pink, and basically looking at expected returns for Tesla over and above the risk free rates. Okay, that's about the equity market, but what about the other market asset classes? What about the bond market? So again, we are looking at some example of Tesla, but this time looking at the bond issued by the Tesla company. Here we are simply looking at the cash flow analysis and discounting the cash flows. And this is very traditional way of working out the value of bond. And this is giving us the present value. And it's not very clear if the current market price is true reflection of fair value price. What about the FX market? Surely a macroeconomic asset class such as FX should follow fair value models. Now, probably the most famous form of fair value in currencies would be the PPP, or purchasing power parity. You can see there 4 PPP models. You may have heard about the Big Mac model relating to the price of burger. But in this case, we are going to look at more sophisticated one, which is OECD model. So here we are looking at 10 major currencies, the each G10 currency versus the US dollar. What's striking here is difference between the spot rate, which is the current market price against the estimated PPP value. So for instance, euro dollar currently 0.96 versus the PPP, the 1.42 is currently 48% undervaluation. Now I know that is that in long term, the PPP and other fair value models for other asset classes would come right and market will come in line with the fair value. But we are going to look at in different, in few minutes, in fact, that many investors can't afford to wait for long term, because the way they are assessed, whether they are fund managers or traders, by their clients and by their bosses, or even if you are on sell side by your client in terms of your recommendations, people are not prepared to wait months, if not years, for the price to adjust fair to the fair value. Okay, so that's the rational side of investing. I think the key message to take away from this is that some of the expectation and requirement assumption of rational investing maybe are not quite transparent as they might appear first appear, and it can be challenge indeed to manage position to invest and to manage the risk on your investment based on those fair value models. For instance, if you buy one of those stock assets like for instance, Tesla, and you had an expectation, and maybe you are looking at analyst recommendation and they are saying we are going up to $301 or something. What if the price falls? Are you still going to wait until the analysts decide to change their target price for next 12 months? Can you afford to do that? What if the price falls substantially in the meantime? Would you instead be forced to close your position if the price falls below the certain level? These are really important questions to ask, because ultimately most traders, portfolio managers are assessed on the performance in terms of price, not in terms of how well an asset work against its fair value model. Now, this leads us to non-rational investing. The first aspect and idea is that all investment decisions ultimately drive from a human decision-making process. Now, you may say, what about algo trading or high frequency trading by computers, and there is no human decision making involved? Well, ultimately, those algorithms are written or driven by human, and they are created by human. And indeed, They often have overrides, and they are built with assumption which again reflect the nature of human behavior. There has been a range of academic research showing that biases in a lot of algo trading do reflect the same sort of human weakness. Now, the second assumption is that any pattern which can be seen in how human mind makes its decision will be reflected in same sort of pattern in the changes in the market price. This whole topic comes under the banner of behavioral finance. Now, the behavioral finance does look into individual behavior, and indeed, it ultimately talks about psychology of individual investor. But the assumption is that because all investors are human, it is extraordinarily rare for any investor to be able to remove themselves from some of the traits, be it the strength or weakness of the way human makes their decisions. So it all comes to sentiment of the market, and that is the reason sometimes investors can't explain certain market moves and call them technical, because they cannot evaluate those movements fundamentally and then try to study the charts as if charts have some magic, but simply it's something they can't explain in terms of rational investing. So again, I will pull myself back to track and not going into details of behavioral finance because it's a complete subject to study. Also, there are many concepts to explore while comparing the rational and irrational investments. Till this point, I think we have achieved enough understanding of what the traditional investment strategies and rational investment models, and also some non-rational behavior, and what are the pitfalls of these models and concepts. Now, we will come to last but not the least topic of our session today, where I'm going to present you a very interesting and kind of a secret investment concept you might not have heard about in mainstream media or through your brokers or bankers. Well, I'm not saying that all these investment valuation model or analysis are useless, but it depends. It depends on you and your strategy as when you actually need them and how you can get benefited from them. Of course, if you can use them according to your requirement, you might get lots of benefits. But real question you need to ask yourself is what you are trying to do and where you want to be in terms of your long-term goals. So for this, and to act rationally, I'm going to present you some ideas and framework which you can use repeatedly in your life without fail to create more wealth. So continuous wealth creation without setback is not possible. That is true. And that this statement is proven right time and time again. We can refer many real world examples. So the key message to understand here is that the investor who intends to build wealth cannot expect a continuous positive fortune building process. Losses inevitably occur and must be anticipated. Throughout history, wealth has been destroyed by events that include wars, be they wars of conquest such as Napoleon War or World War II, be they religious war like 30 years wars in 17th century, where Protestant fought against Catholics, or civil war like Spanish Civil War, and a very recent war between Russia and Ukraine. Similarly, there are many examples where riots, rebellion, and other violent events have destroyed considerable wealth. So wealth has been destroyed by pandemic as well. We have seen that. The point to understand here is because threats and risks can easily destroy all wealth. An investor's critical task is to think about the measures. What measure can prevent substantial setbacks? So if you have fund to invest as an individual or as a member of organization, you probably want to know whether you can create substantial wealth from this starting amount. You may have already consulted financial organizations such as banks and brokers and read extensively in academic finance and journal literature, all of which heavily promote diversified investment in assets such as stocks and bonds, and as well as the products derived from these instruments. So according to many researches done on this, we can say that this approach may help to may help to preserve actually capital, but it is certainly not suitable for investors whose mission is to create substantial wealth. If financial instability, inflation, and higher taxes continues to mark the economic outlook, traditional approaches may fail to even preserve the capital. So mostly when advisors try to convince us to invest in stock, they use graphs of S&P 500 returns from the past, which showed very different performances in different times, and they use selective time periods to show good returns while ignore the negative returns period. So what we can learn here is that to create wealth, an investor would have to apply a very difficult market timing. He would have had to invest massively in 2002, stay invested until 2007, and sell the stocks in 2007, and again invest heavily in 2008 after the crash. Unfortunately, however, there is a fundamental difficulty in understanding market movement even in retrospect. There are many ways to create wealth, and there are two principal concepts, ethical and unethical. I'm certainly not going to discuss unethical method, and of course would discourage everyone to use them, because ultimately it does not end well. But let us take a closer look at ethical concept. As a matter of fact, several options exist, but in general, it is obvious that wealth creation is not an easy task. An entrepreneur must be willing to work intelligently and extremely hard for a long time, mostly decades. It is well known that top management position can usually only be achieved with outstanding capabilities such as know-how, political sensitivity, and hard work. The same goes for artists, sportsmen, sportswomen, and other celebrities. And there are other characteristics applicable to all of these options. They are all linked to often, considerable risk and also to luck, sometimes a lot of luck. In evaluating investment performance, one might easily get caught up in stocks and bond return data, but these data alone do not tell the full story. Investors should look carefully at total returns and real inflation returns. So beside the weak returns of stocks and bonds, and other important factor contributing to poor portfolio performance, that model applied by most academician and financial expert do not give a true picture of expected performance due to simplified models and the application of standard deviation as a basis of return expectation. For example, the CAPM model, capital asset pricing model, optimizing return and risk, and the modern portfolio theory, as these mathematical models gained wider industry acceptance, they evolved into a marketing tool for advisors who claimed that their advice was based on the work by Nobel Prize winning academic researchers. Until today, many financial institutions use this classic concept of risk management, standard deviation, and other measurement based on the normal distribution. While financial markets may follow the law of normal distribution for a period of time, unanticipated events can cause significant deviation with tremendous consequences. Financial market during these rare events follow power law, a kind of a probability distribution where occurrence of rare events have much higher probability than in normal distribution. Many phenomena in other fields also follow power law, such as magnitude of earthquake in earth science and city population and demography. Considering the numerous magnitude such power events have and not knowing the probability of their occurrence, what should an investor do to manage risk? In his book, The Black Swan, Nassim Nicholas Taleb calls the appearance of events that follow a power law black swans. In Europe, only white swans were known until the discovery of Australian black swans. So in the investment world, black swans do not follow normal distribution, and Taleb suggests that investors need to know the consequences of an event, even without knowing the probability of its occurrence. Emphasizing the need to focus on recognizable event consequences when making decisions rather than worrying about the probabilities. And investors who follow recommendation of financial advisors that focus on stocks and bonds may in some cases be able to preserve capital, but to build significant wealth, an investor must strive for considerably higher annual return, and this requires a different approach. Keep in mind that investment always takes place in a dynamic social system. It is essential to understand concept of strategy and their implication for developing a sound investment approach. So finally, I'm going to present you the framework for strategic wealth creation. So I would emphasize on two key points. Wealth cannot be created by following traditional investment advice. If you invest according to traditional diversification concepts and capital market theory promoted by financial industries, you may be able to preserve wealth, or in the best case, generate marginal returns. But to create wealth, that is the second point. To create wealth, an investor must apply strategic concepts to develop an investment strategy that builds on, for example, on investor strength and core competencies. This is the most important point which most of the wealth advisor ignores about the competencies of the investor. So an investor needs to build strength and core competencies first of all, and then exploit the opportunities. They need to use the networks, incorporate an investment approach that differentiate the investor from other. So prevent threats and handle risk appropriately, and observe the trends and cycle and invest accordingly. The strategic investor must build strength and core competencies, and use available resources like personal time, finances, and IT, and so on, in a concentrated manner. And it is advisable to develop the strategy through a formal process, as I have explained in this slide. There are 5 steps: information analysis, development of strategic option, then evaluation of option and final decision, and then implementation of strategy and monitoring of strategy. So all these 5 steps, in all these 5 steps, you have to follow these opportunity, networking, differentiation, and timings, because this is the core strength of investment strategy. Before defining a strategy, we must make a situation assessment of opponent environment. Other factors, for instance, many of the successful investors used a formal analysis of future macroeconomic trends in relation to GDP, exchange rates, income distribution, and employment. But since almost unlimited information is available today, the investor needs guidance to identify the most useful information. Asking key questions during the process of information analysis can help assure identifying the critical information needed. So I will leave you with some important questions, and if you can find answer to these questions for yourself, I'm sure you would be able to create a substantial amount of wealth in long term. So questions are, you need to ask yourself, what are my key strengths? What do I have a passion for? Where are my real interests? Which field of investment, such as asset classes or industries or geographic areas, have the outstanding opportunities? And what networks I can use? Where I can differentiate myself from other investors? Where can I achieve a competitive edge? And where are the critical threats and risks? Which field of investments are attractive from a timing point of view, from an overall trend and cycles point of view? So last thing you need to ask yourself, that what are the cost of key strategic options? So once again, thank you so much for attending this workshop, and I hope you have gained very useful piece of knowledge and understanding. If you want to learn more on this in more details, please feel free to approach me. Thank you very much, and thanks for your time. Thank you.